Everybody to another lunchtime live session coming live from Dubai. Hope you're all well and ready for materiality in ACCA. So without further ado, in AAA even, let's have a look at it then. So first of all, materiality is ISA 320. Not that you ever need to know the ISA numbers. Like in financial reporting, you don't have to know the IFRS numbers. You get given no marks for them whatsoever. But anyway, there we have a user of a financial statement. And that user of a financial statement might see in the financial statements a $500 misstatement. Of course, he doesn't know it's misstated, but he's seen one. Or there's a bunch of misstatements, so all aggregated together, they then become something that's material. Now, when we say material, what we mean is, could those misstatements, either on their own or together, could they reasonably be expected to influence their economic decision? You might think, why have I used the word there and it's him? Well, that's because you don't actually look at it from a user, one particular user. They look at it from a collective group of users. So what could that misstatement or omission reasonably be expected to influence their economic decision? If not, leave it alone. It's not material. If so, go and change it because it is material. Okay, I'm sure you all know that, but now you've reached that stage, but always good to know, isn't it? Anyway, the whole point is that this isn't just a mechanical calculation. There is judgment involved. So, sort of judgment is, first of all, there is a calculation you can do. If that number is really big, we'll talk about what big means, i.e. looking at it from a quantitative point of view, then if it's really big, then it will influence their economic decision, and so therefore it is material. However, it can also be small. It can also be like that $5, what we call qualitative. So it's small, but it's still material because it's maybe a related party transaction. And the idea is that no matter how small they are, we want to know, why are we buying from somebody's brother, you know, if it's literally related. You want to know what director's remuneration is, even if it's not a big sum. You want to know how much they're paying themselves. You will want to know if there's been any non-compliance with things, because if you're non-compliant with things now, like a big covenant on your overdraft, you might be losing your overdraft next year. Or it could be something that turns a profit into a loss. So they've misstated it on purpose to show that they're still profitable when actually they're not, they're loss making. So it could be the size, or it could be just the essence, the nature of what it is. Okay, hope you're all still fine with that. Right. Remember in the exam, as I'm sure you know, you're going to have to do a question that says, what are the risks of material misstatement? So this is where it comes up. What are the risks of material misstatement? Is that 500 a material misstatement or not? If it is a material misstatement, we change it if we can, or we get the client to change it, not ourselves. But if it's not material, you can leave it alone. Okay, so step one. So this is where I earn my money, because this is the really important bit. You need to choose an appropriate benchmark. You probably know these benchmarks: profit before tax, 5 to 10%, total revenue, 0.5 to 1%, total assets, 1 to 2%. So you've got to choose which one, and they will need judgment. So if you're a user of financial statements of a typical PLC profit focused, then probably you're going to use the profit before tax benchmark to calculate your materiality. If, on the other hand, you're a user of financial statements of an investment fund, then you're probably more interested in total assets than anything else. Or if you're a financial statement user of a startup, well, startups tend to not be profitable at all, but you're looking at growth. So therefore, it's total revenue that might be your best judge of what's material and what isn't material. Okay. Now, One thing the examiner did say is you must clearly show the calculation. Okay, you must clearly show the calculation of the range. So if you've gone to profits and profits are 10 million profit before tax, then just say, look, the calculated range is between 500,000 and 1 million, between 5% and 10%. And then you've got to choose the range. You've got to choose which end of the range that you go into. So this is where we come to step 2. Justify your benchmark and justify which percentage are you taking. Are you taking the smaller one or are you taking the larger one? And you've got to do that by linking it to the scenario and by your risk assessment. So this you've got to get in your heads. If the item has a high risk of material misstatement, you want to choose the lower end of the materiality range, the 5 to 10%, the half to 1%. You want the lower range if there's a higher risk of misstatement. Similarly, of course, you choose the opposite. If there's a low risk of misstatement, you can choose the higher end of the materiality benchmark range. But you have to be honest and say that in the exam, it's always going to be a high risk of material misstatement. And so therefore, you'll probably always be using the lower percentage of the range. Okay, but you've got to justify it. So this justification could include things like it's a first-time audit. So there's a higher risk of misstatements. I don't know the client. The entity's industry, has there been recent changes? If there have, it's a higher risk of misstatement, so I'll use the lower range. Have there been any significant changes, acquisitions, disposals, restructuring, new IT, changes in accounting policies? Whatever the scenario is giving you, you've got to put that as your judgment for using the lower end of the materiality range. If there's in the scenario a specific risk identified, please use it. So if there's bonus schemes, well, therefore management wants to get the bonus, so there's potential management bias, so higher risk of misstatement, use the lower end of the materiality range. If there's going concern issues, higher risk of misstatement, lower materiality range. If there's lots of complex transactions, a higher risk of misstatement, therefore, so a lower percentage of materiality. Similarly, if there's lots of dealings with related parties or lots of regulations, because we're worried that with the regulations that we're fudging the figures a little bit to get to pass the regulations, so there's a higher risk of misstatement. Okay, so that's the real benefits of this little 15 minutes that I'm going to do with you, or 10 minutes, or however long it may be. So let's have a look at some common pitfalls according to the examiner. And I want to remind you that there's probably going to be a high risk of material misstatement. And so what end of the range of materialities will you use? Hopefully, the lower end, the lower percentage of the materiality benchmark range. Okay, so common pitfalls, calculation errors when applying the percentages. So, you're an accountant, you should be able to do the calculations. Ignoring specific instructions. Now, this is really key. I've been spending the last 10 minutes waffling on about choosing your benchmark, justifying the benchmark, when actually often it's just told, use this benchmark. But what you've got to then do is justify why I'm using the lower end of the benchmark or the higher end. But please, if they tell you the benchmark is profit before tax, don't use total assets, because you're an idiot if you do. Okay, the examiner's trying to help you. So inappropriate benchmark selection, this is when the examiner hasn't told you, so you've used different one to what the examiner would have done, and you haven't provided a convincing justification. If you had, you'd probably still get the marks. Or you had provided a justification, but it was rubbish. So either no justification, or you used vague generic statements like based on the risks identified. What risks? What is that telling me? Be specific, use the scenario. Flawed justification logic. So saying a higher risk, higher audit risk, higher risk of material misstatement justifies a higher materiality threshold. No, it doesn't. A high risk of material misstatement should mean a lower percentage of materiality benchmark range. Okay, also with me on this, well, sunny for me anyway, lunchtime. I hope it's sunny for you, or at least sunny in your head while you're doing AAA. Or saying an existing client justifies a higher threshold. Maybe it does, but not when the scenario presents new risks like a major acquisition or new systems or going concern. Remember, it will probably be a high risk of material misstatement. So you're looking out for them, really. Okay, so near the end now. This is what you've got to go and learn. You've got to choose the appropriate benchmark. So if it's just a normal PLC, profit focus, choose profit before tax. If it's an investment fund or investment properties, choose assets. If it's, what's the other one? Profit before tax. If it's a startup company, use growth, use revenue. So choose the appropriate one. But remember, often the examiner will just actually give you it, so you don't need to choose it. But in either case, you need to justify your percentage selection. But if they didn't tell you which benchmark to use, justify why you're using it, because even if the examiner disagrees, if you put a convincing justification in to why you use profits and not assets, you'll get the marks. But you've always got to justify the percentage selection. Why am I using the lower end of the range? Well, because there's a higher risk of material misstatement. Where is there a higher risk of material misstatement? In the related party transactions, in the bonus scheme issue, in whatever it is using the scenario. So they're the two steps you've got to really get on top of. And then the last thing is really apply it consistently. This is interesting that a lot of the examiner's reports say that what actually happens is they go through all this hard work and then they don't apply it. Then they just like move on. I've done my materiality. That's my marks. I followed Richard's lunchtime live and I've done it. Well, you've got your number. Use the number. Okay. So that's it. That's all it is from me. There's 12 minutes of hopefully very useful stuff for materiality. It comes up all the time. So it's 12 minutes really well spent. If you are on YouTube, then obviously you can go back and re-watch this video. We do publish them all afterwards. And if you do, please like and subscribe. And hopefully I'll see you on an AAA course sometime soon on aCOWtancy.com. Thank you very much and see you again tomorrow.